Well, thanks to skyrocketing home prices, American homeowners are flush with equity in their homes. In the second quarter of 2023, Adam reported that over 47% of mortgaged homes in the United States were considered equity rich. That's phenomenal. And it's great news for Americans who are sitting on all of that equity. Yet simultaneously, many Americans have fallen into the liability trap and have become burdened with high interest credit cards at the same time. Now, one of my favorite financial mantras is you cannot eat equity. Why would you let that untapped potential sit there in your house when you could instead use it to improve your financial situation right now? Generally speaking, most banks will allow you to borrow up to about 80% of the equity in your home. Again, if you've got $100,000 worth of equity, typically they let you borrow about $80,000, right? And according to the St. Louis Federal Reserve, homeowners are collectively sitting on nearly $30 trillion in home equity. $30 trillion. So if you've got a financial goal you're striving towards, whether it's investing in real estate or paying off high interest debt, tapping into that home equity can be a smart way to make some progress. There are three main ways you can obtain a loan on your equity. So let's go through some of them. First up is the home equity loan. A home equity loan gives you access to a lump sum of money that's based on the available equity in your home. They'll assess, how much equity you have in the home, and they'll basically cut you a check for that amount. This is a very straightforward banking product. The lender assesses your home value and then funds your loan. The terms and the interest rate are going to be separate from your original mortgage. You can expect a fixed interest rate with monthly installments, and you have to pay it back. Like I said, very basic traditional loan product. And this can be a good option for anyone who has an exact amount that they'd like to use or someone who wants consistent, predictable payments. But the next up is my favorite. This is the home equity line of credit. Now, home equity line of credit, or HELOC, is a revolving line of credit. You start with a zero balance, right? It works more like a credit card than a traditional loan. When you start with that zero balance, you have total flexibility. You can use it however you want, and you can rinse and repeat as you pay things down. So usually they last for about 10 years or so. So maybe you get $100,000 to work with. Again, you start with a zero balance, and then you want to make a down payment on a rental property for $50,000. Great. Well, you have 50 left over. You can pay that 50 down back to zero, and you can keep rinsing and repeating. This is why I like this one better than the loan, because they just cut you a check for that loan amount, and you've got that money, and you have to immediately start making payments on it. With the home equity line of credit, you have variable interest rates, and you have more flexibility, as well as a different draw period where you're only going to pay back interest, and you have a repayment period where your payments consist of funds you borrowed plus interest. So like the home equity loan, a HELOC is a supplementary product to your mortgage. It does not replace it. And a HELOC might be more favorable for borrowers who want some flexibility, want funds for future access, or want to start out with interest-only payments. Another option to consider for accessing equity is a cash-out refinance. Now, it's a little different than the first two that we talked about. A cash-out refinance is a loan that refinances the original loan. So you're going to say bye-bye to that original loan. It's gone now. It's being refinanced into a whole new product, okay?